If you just recollect, we started with what bonds are. We started the very basic, and then we looked at the fact that there is something called yield to maturity. And 1 second. Yeah. So we started with understanding what bonds are in general, the fixed income instruments. Then we looked at the yield to maturity as a concept and the relationship between bond price and bond yield, how they are inversely correlated with each other. Higher the yield, lower the price, and vice versa. And we discussed the fact that yield at any point in time tells you the expected return at that moment in time, and yields change with each day. There's a difference between yield and coupon rate. Higher coupon rate being higher than the current market yield will mean that the bond will have a higher than the market price, higher than par or 100, and vice versa. If the coupon rate of the bond is lower than the yield, the bond will have a lower than par or lower than 100 as the price. So these are all the stuff we discussed in the last session. And we ended with the concept of duration. First of all, just to recap, so bond has a coupon rate, a coupon amount, frequency at which the coupon gets paid, and finally the face value is the principal on which the coupon is calculated. Now, this bond will have a yield, and that yield is called yield to maturity. That rate, which when used to calculate the price, which equates the market price to the present value of the future cash flows of that bond. What is that rate? That is the yield of the bond. And yield and price are, I would say, yield and price are linked to each other. Yield known at that point in time, along with the coupon rate and everything, price is known. And price is known, yield is known. So this is where we did this basic stuff. Then we looked at how the bond price varies with yield. As market yields fall, right, the bond prices go up. And as market yields go up, bond prices fall. So when you invest in a bond, investment is not like an FD where you invest money and you get X% interest. The bond investment will fluctuate in its return because the market yields are changing and hence the market prices are changing. So if you invest in a particular bond, let's say a fresh bond issued today at 100 rupees, coupon is 7%, yield is also 7%. Then as if tomorrow the yields fall for the same maturity, the yield in the market falls from 7 to 6, that 1% fall will reflect in your bond becoming higher than 100 because it's giving you 7% coupon in a market which is 6% yield. So the bond price will adjust higher, right?